Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. Great to see everyone. All right, so let's start off this show with a quick look at the economic calendar. That is what we are going to be dealing with in a big way. Not so much the data that we dealt with last week, whether that be non-farm payroll and whatnot, but rather as we scroll into Tuesday, we've got Powell. That's right. So they've moved this was scheduled for noon, I believe, yesterday. The Powell session has been moved back to 12:40 p.m. Eastern. And we also have FOMC member Barr speaking today as well. And then we have a number of FOMC speakers who apparently are just dying to get on the mic because they've had to be quiet during that blackout period. So they are back with a vengeance. You can just see all the FOMC events on the calendar. Now, this is actually possibly useful for us. And the reason for that is more so than any time in the last, I'd say at least 3-4 months, this is the most hawkish look at what the Federal Reserve is most likely to do that we've seen in many, many, many months. Meaning, not only are we likely to get to the 4.75% to 5% level come March, but there is a pesky extra quarter point taking us to 5 to 5.25, which has always been lingering in the background, but it's here. And after non-farm payroll last week, so we had the 1-2 punch of FOMC on Wednesday, non-farm payroll on Friday. Put those two together as we wind down the week, we are looking at 1 to 2 more quarter point hikes taking us into June. The real question now is, look, if we get to 5 and 5.25, gang, that column, which we likely will, this is not a stock market killer. This is not ushering in new lows. This is the more hawkish of the two possibilities that have been lingering for months. What is a little bit more hawkish, therefore a little bit more bearish to equities, a little bit more bearish to say futures like gold and bonds, is the 5.25 to 5.5. This week, we should probably see some course correction from the FOMC members. So every one of those pesky speaking events, come on back to the CME FedWatch tool, really easy to find. Just Google that and you'll get a better idea of what it is the Federal Reserve is hoping that we will take from their comments. Meaning, is 5 to 5.25 it, or should we really still be a little bit more hawkish to 5.25 to 5.5? That will likely get sorted out this week. And gang, the whole reason we look at growth, inflation, jobs, etc., is because that all maps to what the Federal Reserve is going to say and ultimately what they're going to do. And all that is distilled really easily here at the FOMC FedWatch tool. This is macro, gang. It doesn't need to be any more than this. What did that take? All of about 180 seconds. So that's what we want to do. Combine the calendar. What are those events and how does it impact this? And by the way, my Sector Secrets Mastery folks will be diving into this a little bit more because I'll see you all at 3 p.m. today in the Sector Secrets Mastery room, and we'll see what the aftermath of that 12:40 p.m. event is on these target rate probabilities. Can we be a little bit more bullish in bonds? Can we be a little bit more bullish in gold? Can we be a little bit more bullish or bearish in indices? So we'll definitely get into that. So good morning, everybody. Great to see you all. All right, so let's do this. Let's jump into the questions. And by the way, I do get a question for every now and then, which is, hey, Rob, what are we looking at here? What are the indicators on this screen? So right now, it's a little busier than I normally would have for charts and coffee, but it is all the tools that help me make decisions using price, time, volume, volatility. So I've got the hourly price movement ranges, the HPMRs, running on the 5-minute. I've got the daily price movement ranges running on the 1 hour and on the daily. And I've got my sector slow stow, perfect for choppy, overbought, oversold analysis. And I've got my V-score, my volume tool at the very bottom there. So that's what's going on this chart. All right, so with that being said, let's kick it off with, let's see, our first question. Oh, comment. Hey there, Stacy, my fan club president. Thanks for hitting that like button. Absolutely. Have a great trading day. Love, love, love the vibe there. All right. Thank you, Stacy. Moving on to question about FCX. Sure. Do I want to be a buyer in FCX? So let's move over. Let's move the 5-minute chart kind of over. And let's focus on the daily and the hourly. Those are time frames that'll allow us to take trades overnight. I'm not quite there yet, Battlehawk, but it is on the radar. We'll definitely be keeping an eye on that moving forward. It is a long position I would be looking for. PM, hey there, Eden. Yeah, well, Eden, I'll see you in the mastery in a little bit, and we'll talk about PM. If I'm looking at this with a fresh set of eyes today, am I as keen on entering as I might have been previously? Possibly not. It is still green. I still want to be a buyer on the daily. It would be great for the 1 hour to find some support and go neutral. Again, another view that might be helpful with PM is to jump on over to look at the wave. So I'm going to do this here. Let's move this view over and just take a really good look at the daily time frame with the wave. And I'm going to remove the DPMRs just for some clarity here for a moment, so we can really hone in on what a mean reversion would look like. What is the mean reversion on PM? And you can see we do have a really nice mean reversion happening right now. So we'll be talking about possible long positions and whether or not we want to continue to be bullish. But remember, I think the more important thing is take a look. Earnings are just 2 days away, which means that I'll likely want to do what? I will look for a setup in the aftermath of earnings, and it's going to be really important that I exit before that earnings. So that means we've got to be out of PM. If we have a long position, anyone out there, including my sector secrets folks, we've got to be out by end of day on the 8th. All right, next up. Hey there, Frank, how are you? When can we sign up for your next class? I do appreciate it, Frank. Lorna and I are, and Trish, know the folks in the background that make me look really good, sometimes better than I deserve. We are all working on testing what we're going to be bringing forth for the next class. We are 10 months in, and we're continuing to test what we do and don't like. Frank, I think the biggest thing, and by the way, it's going to be in March. It's going to be in March. We're actually moving the date back just a little bit. I believe it's going to be the 11th. So that's when the class is going to be. And I think we're also moving this back to the 22nd. And the reason is I just want a little bit more time to make sure that I'm addressing what the biggest problem that Lorna and Trish and I have been receiving regarding traders saying, Rog, I don't know what to do in this environment. I'm going back to work. Day trading is, and I don't have this confirmed yet, gang. I'm just giving you a guesstimate, Frank. To be quite frank, I'm giving you a guesstimate so y'all can at least plan somewhat accordingly, but it will be in March. So the thing to remember about where we are right now is how are we adjusting, not reinventing the wheel, right? But how are we adjusting to the kind of environment that we're dealing with right now? And for what I've been seeing and testing, that adjustment to a 1 hour daily is allowing me to take advantage of overnight positions with some decent follow through, not necessarily having to do the kind of day trading that we did and love to do in 2022, but opening up in addition, not supplanting, in addition to the day trading. How do I use the 1 hour? How do I use the daily to take short-term swing trades, right? Short-term, nothing long, nothing dedicated to weeks and months out, maybe days, maybe a week. And that adjustment's been working great. And as we continue to fine tune that and then really put the finishing touches on the DPMR, we're gonna definitely be coming out with that class probably the middle of March, and probably the second week of March is my guess. So thanks, I appreciate that, Frank. Thank you. All right, Avi, is that going to be crazy to change a 34 EMA weight? Is that going to be crazy? Oh, what if you want to change the wave to 21? I'm not quite sure the question, Avi. So the 34 EMA wave is the 34 EMA wave. Now, would I ever make it the 21? Frank, sorry, Avi, I tested, kind of still thinking of Frank's question as far as testing. We test everything for months and months, if not years. We want to go through multiple seasons. We want to go through multiple environments from a monetary policy perspective, from a volume perspective, from trends. You can't create indicators in months, gang. There's no way. There's not enough time to stress test it. And so ultimately, when it comes to the 21, I tested the 34 for decades, and it just works the best for what I need. However, to acknowledge that 21, like you said, that's where the TOPS platform includes that 21 propulsion. And while I do like it, I still like the wave for the mean reversion, but an aggressive retracement. I do like the 21. Now, if you want to test out a 21 wave, go for it. I think, for me to say, just go ahead and believe me. Look, a lot of us need to test things out. I can appreciate that. But suffice to say, I've got hundreds and hundreds and hundreds and hundreds of trades, if not thousands at this point, based on and designed by what the wave is telling me. And the 34 just from a probabilistic standpoint, not exceptions, it just works the best, right? So all right. What's the difference between, hey there, Robert, what's the difference between the yellow and purple? Really nothing. They're just meant to pair up easier. So visually, if I had nothing but, say, maroon lines, or visually, if I had nothing but purple or yellow or white lines, they're hard to pair up the boxes, because remember that these are actually boxes, right? If this was a Darvis box, we'd have the sides on the box. The reason I don't like the sides is they cover up the wick, they cover up the candle. That's no bueno for us. So I take the sides of the box off, and it just makes it easier to pair up the two lines to make the visual of what we've created. This is just basically a channel. All right, thoughts about the DXY short on the daily. So I'm going to go to the 6E, and I'll explain why in a moment, 403. Do I want to be short and let's do this. Let's head on over here. Do I want to be short the dollar? I agree. I do want to be short the dollar for many reasons. I think the most primary reason is the U.S. is winding down a hawkish monetary policy. The tightening cycle is coming to an end. 1 quarter point, maybe 2 more quarter point hikes. The European Central Bank is on the way up. So you might say, Rod, what does the European Central Bank and the euro have to do with the U.S. dollar? The US dollar and the euro have a high 90s inverse or negative correlation. In other words, when one goes down, the other one goes up. It's just that tight. It's the tightest correlation of any kind in any market. And therefore, if the euro is moving higher, the dollar is moving lower. And that's been the general direction. Now, the last ECB meeting did sort of knock the euro a little bit for a loop. But for the most part, the trend is still up. We're still north of the 200 propulsion. Why do I bring up the 6E? Well, sure, we could pull up DXY, but the best way to look at currencies is through Forex. The second best way to look at currencies is through the futures market. There's about 250 billion turnover per day. So there's a lot of opinion. There's a lot of money flowing there. That means that we're getting a really good global idea of what's happening with the euro and the dollar. And therefore, when I'm looking at the euro, I'm looking at the dollar. Only the euro is more accessible to trade as a futures contract. There's a micro futures. There's an FXE ETF as well as the UUP. So my preference is usually going to be look at euro. It's just easier. And remember, when you look at the dollar, it is a basket. It's not unlike looking at the Dow, where the Dow is made up of a high concentration weighting of individual stocks. Well, the dollar basket, this includes UUP, DX futures, and the DXY is also a basket of the US dollar versus 6 other currencies. Nearly 58% of that weighting is this thing right here. So this is going to be your best view of what the dollar is doing, because this is the most highly concentrated currency in that dollar basket. And that's why I always revert back to that euro conversation. So do we like the short? 403, I do. I want to take advantage of any kind of dip in the euro to buy it once it gets to levels that make sense for us to manage risk from. And then at the same time, or alternatively, that should set up a short in the dollar. And when the long in the euro set up and the short in the dollar set up time well, we know we've got a good trade. So I'm definitely going to be looking at that. And by the way, it's not only, well, let me do this. It's not only the euro that there's some impact. When we look at the dollar, let's think about why the dollar would go up or down for a moment, because what else maps out from there, 403? What else can we look at? Well, if the dollar's going to go up and down based on expectations for rates, by the way, why is the dollar up? Because for the past Wednesday, Thursday, Friday, Monday sessions, 4 sessions, we've been slowly discounting, expecting another 1/4 to 2/4 point hike. So slightly higher central bank rate is bullish for the currency of that country. So yeah, of course, the dollar is going to move higher for a little bit as that is making its way through the market. Also, market thinking. Also, bonds are going to move lower because bonds moving lower actually indicates higher yields. Why would we expect higher yields? We're expecting potentially 2 more rate hikes, 1/4 point rate hikes from the Federal Reserve. So there's also a potential for a buy in bonds. Bonds and dollar should ideally go in many ways. So if the dollar is moving lower because it's weaker and euro's moving higher, bonds and dollars should move opposite. Or another way to look at it is bonds and euro should kind of move together. And that tells us when they're moving together, there's clarity, right? There's clarity sort of siphoning in, being distilled from the standpoint of what is the Federal Reserve going to do? What are rate hikes going to do? Really, really, really simple. Yeah, really simple in terms of what are we looking at, right? Let's not complicate it. I know it feels good to complicate. I know it, it might feel good to make macro this very complicated thing, but macro is really one question. What's the Federal Reserve going to do? And we can add a little bit more to that by saying, what is the general gist of G7 or G8 central banks? What are they doing? Are they tightening? Are they cutting? And they're all in different parts of their tightening cycle. So it's not as if they're aligned. And remember, the Bank of England went first and the US central bank went second, the FOMC. We're just about done. Euro has more upside, dollar has more downside, and that's the way I'm going to play it. And then think about what bonds will do in accordance with that analysis. Yeah. All right, gang. So I think that's it. 60 is moving down right now. How do I see that? How do I see that it's moving down? Or how do I see I want to be a buyer? Mike, I don't quite get the question. So 60 is moving down. Correct. Yes, you can see the red grab candles. You can see the lower lows. Yeah, absolutely. But I do want to be a buyer because remember, uptrends just don't go straight up. They're going to retrace from time to time. The last time we retraced, you can see was early January, and that led to that next leg higher. So chances are, if we're going to see the euro start to bottom out and the dollar start to top out, it'll be this week. So how do we see the euro is moving down? So they move opposite one another. They move opposite one another. So how do I see the euro moving down and assume the dollar is moving up? Their correlation is about 96 or 97% an inverse correlation. But they will quite literally move tick for tick opposite one another. All right, gang, and just like that, my time is up as always. Thank you so much for being here for Charts and Coffee. I'll see you all. You got it, Mike? Oh, perfect. Yes, that's how we see it. We can look at one market, Mike, and understand a lot about the different currencies and how they're moving against the dollar. Absolutely. Thanks for the question. Okay, gang, I will see you all on, I'll see you all tomorrow here at the Simpler Trading YouTube channel. My Sector Secrets folks and my futures folks, I will see you shortly. In the meanwhile, gang, be good to each other. I will see you all Wednesday, same time, same station.